Good evening, everyone. We have today's Sky High Symposium, Series 6, and I welcome all of you on behalf of the Institute of Chartered Accountants of India and Women Members Empowerment Committee. It is our endeavor to serve the best to the members and specifically by this WMEC to the women fraternity of the Institute. And today we have our Central Council member, very respected CA Gyan Chand Mishra ji. Welcome, Central Council member Gyan Mishra ji. We have with us our beloved and very senior faculty, CA Neena Kapasi, who will explain us about the TDS and TCS intricacies. And as we all are aware that the return filing dates for the TDS return are 31st May, and there are a lot of issues in day-to-day life for the clients we are facing about the TDS. Every now and then the clients are calling what are the rate of the TDS and they are not aware. So Neena Bin she has always been mentor to me and having a vast exposure in this direct tax. So thank you, Neena Ben, for joining this session and accepting our invitation. We have with us CA Shefali Arora, and she will be going us through the investments in the areas into the investments as an opportunity for the chartered accountants. So first thing, we chartered accountants, whether in practice or in industry, they don't know about their own investments and for their clients also. So Shefali will actually run through us how we can plan for ourselves as well as for our clients. And she is into this since last more than 1.5 decades. So thank you, Shefali, for joining this session. And we have our coordinators, CA Pallavi Mayur, she is a past chairperson of Jalgaon branch, and CA Pallak Tikmani, who is a managing committee member of Thane branch, and one more coordinator who will join now. And with this, friends, if you have any suggestions or any support required from WMEC of ICI, feel free to connect to us. We want all of you to come forward, be the coordinator, be the speaker, and that is why we are started with this symposium. And we have with us, I said in the beginning, CA Gyan Chand Mishra ji, who is a Central Council member from the Central region. And at present, he is having a great portfolio. He's a vice chairman of CPE committee, as well as he is also there on the disciplinary bench along with me for the East, and and one more, I think one more committee is a vice chairman. Gyan ji, और कौन से committee में है? हाँ?
So, Preeti Ben, you have given a lot of introduction of mine.
Sir, and actually, sir, we invite you, and we are happy that you are here to motivate all the participants and your support. See, it is not possible only women can do. It is always with the support of all the council members we are able to do. And that is what you have agreed to join and share your thoughts. So I'm really happy and invite you. I am happy and glad to receive you over here. And I request you to share your words of wisdom. Over to Gyan Bhai.
So thank you for such lovely introduction of mine. At the outset, I am really very encouraged to be in the meeting of High Symposium 6. So at the outset, amongst the top brains of the institute. Before starting, actually, I was just listening to Preeti Ben. I have something to share with the members who are participating in this program. And usually I used to have at least one stanza of Ramcharitmanas whenever I get the opportunity. So this is a situation of Ramcharitmanas where God Ram goes to jungle with his wife and brother. Are you audible, people? Voice is clear?
सर थोड़ा आवाज ब्रेक हो रहा है बीच में.
Okay.
हाँ अभी आ रही परफेक्ट है.
So what this is the regarding the empowerment of women. I just wanted to share with you. So जंगल को जाते हैं सीता जी के साथ में और सीता जी का अब ले जाता है तो उन्होंने अपने भाई लक्ष्मण को एक बार बोला, घन घमंड बरसत नभ घोरा प्रियाहीन दर्पत मन मोरा. We always always see that as per our mythology, God Ram was one of the greatest philosopher and he used to be said Maryada Purushottam. So you see the women empowerment at that time, he says that he is in jungle और उन्होंने अपनी गोरा अब प्रियाहीन मन मोरा, मतलब इतना चारों तरफ घन घमंड हो रहा है, बारिश हो रहा है, लेकिन मेरा डर रहा है, like this. तो भगवान राम भी at that time he just shows his respect towards the women empowerment at that era of time. So my feeling is women have always been empowered across the universe, across the globe, at any point, at any time of the era. So this is really, I am thankful that Preeti Ben has given this opportunity to me. Respected Sri Priya Madam, in her absentia, I don't find her in today's this program. Of course, to the entire committee of the Institute of Chartered Accountants of India, their officers, and today's speakers, Neena Madam, and the other her co-speaker, and of course participants. Good evening to all of you. We all know. Madam, am I audible? My voice is coming?
Yes, sir. Perfectly audible.
Okay, great. So actually there is some network issue. That's why I just thought to check with you.
Yeah.
So the topic being taken today is really very matter of sense. Actually, TDS, TCS, routine working of the chartered accountants, and we have to comply with the certain regulatory requirements, and of course, compliance part for the chartered accountants and financial planning. Again, one of the very important part of not only chartered accountants but for a human being, because the era where we are living with, that is really a finance era, and we have to manage our financial side in such a manner so that we could attain the goal of our life exactly. And this is a sense of the financial management always gives a sense of freedom also. So when it comes to managing the spending, managing the expenses, investment part, and liability part, all these things come under the financial management program. Members at large who are attending the program, and the time where we are going nowadays, inflation is taking up like anything. Government is looking for it, and a lot of initiatives also has been taken by the government. Just RBI rates have been also 40 basic points have been increased. So in given all these circumstances where EMIs are set to increase, inflation is rocket high, how to again manage the expenditure and financial things on routine basis, and of course to the objectives of the life at large. I'm thankful the committee that they have given this opportunity to me to interact with the best brains of the institute, not only with respect to all these things, but I'm sure the committee has such wonderful initiatives that members at large are getting benefit. Not only the women members, this is really for all the members across the country. So I congratulate to the entire team of the committee and especially to Preeti Ben, among part of the best brain of the country. Thank you, Preeti Ben, for giving me an invitation.
Thank you, Gyan Bhai, for your address to WMEC participants. This is really, I can say, motivating to all of us, and it will really support all the members. And your encouraging words are inspiring to all of us, so that we are inspired to do more and more work for our fraternity. Thank you for sharing your words of wisdom, and in spite of your busy schedule, being over here for your address. Thank you very much, Gyan Bhai. Thanks a lot, and looking forward your support in future also. Thank you very much.
Thank you, madam. Thank you for giving this opportunity.
And now let us take this session further. And we have very beautiful, we all here gathered here, all beautiful and talented brains, all women chartered accountants. And amongst us, we have our beautiful coordinator, CA Palak Tikmani. And I request Palak to please introduce our very respected speaker for the first session, CA Nina bin Kapasi. Over to Palak.
Thank you so much, Preeti ma'am. A big shout out to you for organizing such knowledge enhancing sessions with such great topics and such excellent speakers. Thank you so much for giving me this opportunity. Good evening to everyone and all the dignitaries and all the lovely participants. It's my pleasure to introduce our first speaker for today's session, CA Nina Kapasi ma'am. She is a practicing chartered accountant. She is practicing in the areas of taxation, audit, and management consultancy. She's a law graduate from Government Law College. She's a core group member of BCAS, that's Bombay Chartered Accountants Society. She is a regular speaker at seminars and workshops organized by various professional organizations. She has been a contributor of articles in magazines and newspapers of professional interest, including BCAS, Referencer, BCAS, Budget Booklet, etc. She has led various group discussions and she has addressed lecture meetings on taxation and finance and investment. She has co-authored e-learning modules on TDS prepared by BCAS. She has co-authored Outlook publication, Layman's Guide to Income Tax. She has co-authored Handbook on Role of Women Directors published by ICA in 2020. She is an independent director in Apar Industries Limited. She is a trustee of Akshara, an NGO engaged in women's issues, and she has been pioneer in Helpline 103. I now hand over to Nina Kapasi Madam to put light on issues and intricacies on TDS and TCS. Thank you so much.
Thank you, Palak, for kind words. I understand that I am audible.
Yes, ma'am.
Yeah. Okay. Very good evening to all of you. At the outset, I am thankful to CA Preeti Savla, Vice Chairman, Women's Empowerment Committee, and my dear friend. And welcome to Shefali, Pallavi, Shanu, all of you. I am thankful to see Preeti, because, otherwise I would not have studied these intricacies of TDS, especially newly introduced section 194R, 194Q and 194S, which are going to be applicable from 1st of July. So thanks for giving me this opportunity. Now, we women professionals are destined to be empowered, provided one remains committed and focused. Now, only thing is, our road to empowerment is a bit bumpy, full of turns and side turns and U-turns and reverse too, combined with our various other duties such as marriage, kids, family responsibility. It is not like highway, like most of our male counterparts. So the concept of TDS, coming to the topics of proper, the concept of TDS is age old and known in different spheres of life with different names, When Dadima of the house, when she takes out first laddu for giving bhog to this Bal Gopal, it is TDS. If mother takes out first roti for feeding Gau Mata, it is TDS. Or if father takes out first bite of ice cream to check taste and freshness for kids, it is TDS. So this concept of TDS is well known to all of us. But now, coming to this income tax, where the net of TDS is over expanding, just where it is, ever expanding, and share. Yeah. Just allow me to share the screen. Yeah. I think now the screen is visible. Am I right?
Not yet. Yes.
Is it visible now?
Yes.
This is not good. Just give me 1 second. Yeah. See, if you see this collection of TDS in overall tax collection is increasing every year by year. If you see in last 10 years, it has gone from 34% of total direct tax collection to 45%. So almost a jump of 10%. And if you see, the country is moving towards digital administration, the way we have seen it, So now provisions of TDS and TCS are expanding every day. Earlier, the provisions were only up to alphabet, O, R. Now it has gone to S. And now only T, U, V, W, X, Y, Z has remained. And in between, so there are also, 194 AA, 194 BB. So there are many multiple provisions, and the net of TDS like an octopus increasing day by day. If you consider SFT, which is also now mandatory for many of the organizations, combined with 26 A's and AIs, first time we are going to see pre-filled return for AY 22-23. That talks of digital administration, tax administration of India, and the way they have improved. Similarly, CBDT and CBIC, they have made a compact for sharing the information. Now that is more relevant when you are going to examine provisions of 194Q and 206C1H, where TDS is to be deducted on sales or TCS to be collected on sales, So these kind of intricacies are very much required to be examined. We are also having now faceless assessments and faceless appeals. So where we are not going to interact with her officer on first to first or one-to-one basis, but someone sitting in Guwahati is going to examine someone sitting, some tax assessee staying in Bombay or something like that, and we are nowhere going to get the link. Similarly, the department has also moved forward in data mining techniques and algorithms and advanced techniques to find out any tax leakage. So the idea is to collect the data from all sources and identify the inconsistency across various filings, legislation, and so as to make non-intrusive assessment based on reliable data. Now, this was not possible before 4 or 5 years, but considering the notices of reopening or various 148A, the way it is flowing, you realize that this everything has to be, though the tax compliance is very good and you are also getting the refund very quickly, the TDS is also to be done properly in a proper way. Now, what is the TDS and tax deductor is nothing but an honorary tax collector. It's a kind of a outsourcing partner where on the behalf of the government, they are collecting taxes. So it goes well with philosophy with pay as you earn. So here now it is deduct as it is being earned. As far as tax deductor is concerned, there is no additional financial burden, but he is responsible for deduction of the right amount at the right rate, under right section, and in right time. And the payment has to be done to government treasury in time. So deduction also has to be in time. The payment to government treasury also has to be in time. Having paid the taxes, having deposited the TDS in government treasury, it's required to upload quarterly statements. Post that, he has to deliver TDS certificate in form number 16, 16A downloaded from NSDL to various deductees. These are the basic duties of tax deductor. Similarly, as far as tax deductee is concerned, they are entitled to only net amount, that is net of TDS. But definitely the taxability will be on gross amount. So say, for example, your professional fees you are getting out of 30,000, you are getting 27,000 after deduction of TDS of 10%. But what one is required to offer is only 30,000. However, this credit of 3,000 we will be able to take as and when we are offering this income as for taxation. If one has taken if the TDS is deducted on payment and the income is spread over many assessment years, then the basic proposition is that proportionate credit will be given in various years as and when the income is offered. Now, there are various heads under taxes required to be deducted. As I have told you that right from 193 se leke 194A ka 194, 194A se leke 194 as tak to it's already reached. Now only T and to Z has remained. So basically, if we are aware that salary, interest, dividend, contract fees, professional fees, rent, commission, these are the normal provisions which it is applicable to practically all of our clients, But there are many additions which we will consider. Deduction is normally at earliest, whether when payment or credit, whichever is lower, whichever is earlier, not lower, whichever is earlier. So deduction has to be done at the earliest time. Payment is to be done by 7th of next month. However, if the payment tax is deducted in month of March, then the payment is extended time is given till 30th April. Quarterly statement is to be filed by 1 month, end of 1 month from the end of the quarter. So say, for example, for first quarter up to 30th June, you have to upload your quarterly statement by 31st of July. However, for last quarter, that is March quarter, it has to be filed by 31st May. For TCS quarterly statement, the time limit is a little bit shortened. You have to do it within a period of 15 days from the end of quarter. So instead of 31st of July, in such case, it will be 15th of July. But for March quarter, again, there is an additional thing, it's extended till 15th of May. If you don't file your TDS, if you don't upload your TDS quarterly statement in time, there is a late fees, which is 200 rupees per day under section 234E. This is the basic proposition. Now, if you don't do it, then there is a lot of stick. Maybe there is no carrot as far as outsourcing partner of tax collection for Government of India, but there are lot many sticks. So if as a deductor, if you don't deduct or if you don't, after deduction, you don't make the payment, then assessee is deemed to be in default under section 201(1). What are the consequences? Consequences are that you will be required to make payment of taxes plus interest at the rate of 1% per month or 1.5% per month based on collection or payment, plus late fees, as I've told you, 200 rupees per month, plus penalty under section 271H. Of course, it will be subject to reasonable cost, where it is minimum of 10,000 or maximum it can extend to 1 lakh. Prosecution is also there Section 276B, 276BB, and 276C. Earlier, I'll tell you, in my first 25 years, I have never seen this TDS prosecution notice, though few of the provisions were already there. But of late, now one has also started seeing notice of prosecution, which is quite terrifying. So one has to be very careful. Over and above all these consequences, there is a disallowance of expenses which are subject to TDS, and where you have failed to deduct, or after making payment, after deducting it, you have failed to make the payment, there is a disallowance under section 40A1 or 40A1A, where your 30% of expenses will be disallowed. So this is something very scary, which can change your entire computation of income. In few of the countries, they are given some benefits by way of a reduction in taxes for being a honorary tax collection agent of government. In our country, it is not there, but one day with development of economy, with development of mind, I understand that this will happen. Now let's take the recent development I will be taking. So now this is a one thing, which is a section 206AB. You are aware that, when the pen is required to be furnished for your deductor, and if you have not furnished, then 206AA is applicable, and the tax is liable to be deducted at higher rate of 20%. The government has collected, rather, it spread the tax net because of this provision. And after tasting the success of this 206AA provision, they moved one step forward to 206AB, which says that if the deductee has not filed his TDS of his ITR, income tax return, of earlier 2 years, then the rate which is higher of twice the rate which has been specified, or twice the rate, or rates in force, or 5%, whichever is higher will be applicable to you in place of original rate of TDS. So now, but it is not applicable to certain provisions. Say, for example, TDS under section 192, 192A, 194B, BB, and LBC, which talks of basically salary, lottery winnings, horse winnings, cash withdrawal from the bank, etc. Okay. Now, where section 206AA is also applicable, where there is no PAN, and as well as there is no, even income tax return is not filed, then the higher rate will be deducted, not collected, but it will be deducted. Now, similar provision is also there for TCS. So in case of TCS also, when there is a non-filers of ITR, rate will be higher of twice the rate which is specified, or 5%. And similarly, when there is no PAN, then higher of 206cc, that is no PAN provisions, or this 206cca will be applicable. Now, what is the specified person? Specified person is such that person who has in both previous years, who has not filed his return of income, whose time limit has been expired. So when we consider AY 22-23, we cannot consider the AY 22-23 because the time limit for filing AY 22-23 return is not expired. But one has to check AY 2021 return whether it has been filed or not, and AY 21-22 return whether it has been filed or not. So first condition is that both the years, earlier 2 preceding years, the return should not have been filed. Secondly, aggregate of TDS and TCS combined together is exceeding or equal to rupees 50,000. So when both the conditions are cumulatively satisfied, that both 2 preceding years returns whose time limit for filing has been expired, plus aggregate TDS and TCS of both the assessment years are equal to or exceeding rupees 50,000, then in that case, TDS will be deducted at higher rate, which I have already been discussed, that is twice the amount rate or 55%, whichever is high. Now, how do you check whether what will be applicable, section 206 AA or 206 AB, how the flow will go. So one has to check whether TDS is applicable under relevant section. If it is yes, then check whether PAN is furnished to deductor or not. If it is not furnished, definitely you have to go for 206 AA. And if it is furnished, then you have to check whether the deductee has filed return of income of previous years. If both the returns have been filed, then 206 AB will not apply. However, if the returns of both the years have not been filed and TDS and TCS are exceeding 50,000 in each of the past two previous year, qua such deducting, in that case you have to deduct TDS at the higher rate. So this is the way the flow will happen. Now, how do you check this? How do you check this? You know, your deductee, you can take the copy of the PAN, but whether he has filed his return of income for both the years, whether he has not filed, whether his TDS and TCS are this in excess of rupees 50,000 rupees, it is difficult to check. So the government has started this compliance check, and it is available on reporting portal of IT department. In this, search is possible through single PAN or multiple PAN. Now, this search result documentation is also possible, because in case of any default, you will be liable for tax plus interest plus penalty plus prosecution. So you need to keep proper documentation to check that you have taken the proper search for checking whether that ITR has been furnished by the deductee or not. So there is a logic of functionality which I have given, and I am not considering one can go through it. Only thing is that, if at present the return has not been filed and the date of filing return has not expired, or maybe there is a reopening notice, and in consequence of reopening notice, the return of earlier year whose time limit has been expired, but due to section 148A, he is filing the return, then he will be out of this 206 AB provisions, and the deduction will be at the normal rate. Okay. So this is a compliance check facility which is available on the income tax site. One can check and one can examine before going through this tax deduction, because otherwise all the consequences of assessing in default will follow. The next is TDS in case of a specified senior citizen. Now, two categories: senior citizen, which are 60 years of age, and super senior citizen, which talks of 80 years, where that tax basic exemption limit of 5 lakhs is available. Now, as far as this section 194 is concerned, there is a third age limit of 75 years. If the assessee has completed 75 years before the end of the assessment year. So now in that case, this is basically a facility which is given to this specified senior citizen by the government of India. Now, where the assessee is a specified senior citizen, that is completed 75 years, and he is having only two income. That is, one is pension and secondly interest income. And both the income he is getting from just one bank. In that case, he can submit form number 12 BBA to that respective bank, and the bank in such case will compute his taxable income after considering the declaration, after considering the deductions which must have been given in form 12 BBA declaration. He will give effect to section 80C se leke 80U deductions, the effect will be given. The effect of rebate will also be given under section 87A. And then the bank will deduct TDS at rates in force, whatever is the So basically the competition will be prepared, but in that competition only two incomes will be there. One is that pension income and secondly interest income. And both he is getting from the same bank. Now here the rate will be as whatever is the rate which is applicable plus surcharge and education at regular rates will be included. And whatever is the tax comes, that tax will be deducted. Here there is no bar from opting for alternative tax regime. So one can go under section 115 BAC and compute the taxes accordingly and the tax will be deducted. TDS certificate to such payee will be given in Form 16. Once this is done, then specified senior citizen is exempted from filing return of income and provisions of section 139 will not be applicable. What about if there is a refund, In that case, there is no option, but I understand there is no clarity on that, but I understand that one has to file regular return by taking Form 16, which have been received as a base, and one has to file the return of income. There are few concerns relating to revision of return notices and assessment. However, considering that, this is applicable only to handful of simple people who are having only two income, salary income, pension income and interest income, this should not be a problem. But there is no exemption. There is exemption only as far as application of section 139, but there is no exemption from notices, assessment or other process. So one may continue getting those things. Specified senior citizens I have explained you. Now, what is the specified bank? Now, this facility is not given to all the bank. It is given only to specified bank. Specified bank has been defined by notification number 98, dated 2nd September 21, which means a banking company, which is a scheduled bank and has been appointed as agents of RBI under section 45 of the RBI Act. Now, I was going through this definition in detail and I found that practically all nationalized banks and few of the private banks are also included in this. So when the assessee is having just a simple pension income or interest income, one can go to that bank and request for that. This facility is given as additional, and I am sure this may not be chargeable. Now, this declaration and evidence, whatever has been received on Form 12 BBA, they are required to be maintained by the specified bank and shall be made available to PCIT and CCIT as and when required. Quarterly TDS statement by bank has to be filed in section 24Q in Form 24Q. So basically, this will be considered as a kind of a salary. Okay. Now the next is TDS in case of purchase of goods. So this section 194Q, which has already been introduced with effect from 1/7/21, but the repercussions are many, and it is considering that provisions of section 40A(1)(a), there can be, if the TDS has not been deducted, there can be huge addition to your income. And there are many issues which have come across in the regular day-to-day practical application. So one would like to explain once again. So now this is applicable on purchase of goods. So when normally, when we started the practice now, that time we used to tell our juniors and other audit staff that whatever expenses, one has to generally assume that they all are liable for TDS subject to threshold and other conditions, except purchases. Now, since last 2 years, even purchases are covered. So earlier, the 206C(1)(h) was introduced from October 20, where tax has to be collected on sale of goods. Now the mirror image, that TDS is deducted on purchase of goods, have also been introduced. This TDS is effective at the rate of 0.1%. but it is applicable only to specified person. It is applicable to normally resident, but it can also be applicable to NRI if the NRI is having PE in India. This buyer should have turnover of in excess of rupees 10 crores in the financial year immediately preceding the financial year in which the goods are bought. So when you are examining the accounts of AY 22-23, one has to check the turnover of AY 21-22, whether the turnover is in excess of 10 crores, then only say provisions of section 194Q is applicable, not otherwise. So with that, if the company or firm or this reductor is in existence or it is the first year of incorporation, then the provisions of section 194Q will not be applicable. It talks of purchase of goods. So it can be any goods. It can be capital goods also. It can be regular stock also. So if one buys plant, which is in excess of, say for 50 lakhs, then definitely it is covered by section 194Q. Services are not covered, but you are aware that it is covered by either 194C or 194J or 194H. So for proper reasons, it is only goods which are covered under section 194Q. Now TDS to be deducted if purchase of goods are in excess of 50 lakhs rupees. So this 50 lakhs rupees you have to check qua each seller and not in totality. So if XYZ company buys goods from Mr. A of rupees 40 lakhs rupees, from Mr. B 60 lakhs rupees in a year, and Mr. C 30 lakhs rupees, then TDS to be deducted only in respect of Mr. B because the goods purchase of goods qua that seller is in excess of 50 lakhs rupees. Now that for that aggregate purchases are to be considered and not a single invoice. Okay. Again, when there is no PAN, then the higher TDS will be applicable under section 206 AA and AB. There are many issues when you are going through this section 194Q. For that, the government has also come out realizing that once it has been applicable from 1st of July, there are going to be many issues. So they have come out with a circular 13 on 30th June, which takes care of few issues, or maybe at times they are complicating more issues. So first is whether to be when the invoice value, whether when one has to cut TDS on that GST amount also. So if the invoice value is showing GST separately, in that case, you have to consider only in the amount which is net of GST and not the total amount. But in invoice, if GST is not shown separately, then it is the entire amount, the TDS will be deducted. Trade discount, rebate or cash discount, how this will happen? If trade discount is part of the invoice, then in my view, only the net amount will be considered for TDS purpose. Rebate, again, same, if it is part of the invoice, then definitely only net amount will be considered. However, I understand that cash discount normally happens post invoice, where a separate cash discount is given. In such case, that cannot be excluded for the purpose of calculation of TDS. However, cash discount is also given while preparing the invoice, then only net amount will be given. What happens in case of a purchase return? So if seller returns money, in that case, this circular says that you adjust against next purchase, assuming that there is going to be a next purchase, but it may not happen also. If goods are replaced, then no such adjustments are required, and whatever the replacement TDS, for TDS against that replacement, one can adjust the TDS. Now, this goods can be of any goods. So shares and securities also sold, they are goods. But if such transactions have happened through regular this stock exchange, or it has been cleared to officially recognize regulated clearing operations, clearing exchanges, in that case, they are not liable for Section 194Q deduction. Similarly, power happened through recognized power exchanges are not liable for TDS. As I have told you, it is not applicable in year of incorporation. So it is also not applicable when seller's income is fully exempt from income tax. So but if it is, say, for example, Section 10 entities, where their income is fully exempt, then Section 194Q is not applicable and one is not required to deduct TDS for purchase of goods from such entities. However, where seller's income is only partially exempt, then this exemption will not apply and TDS under Section 194Q will be applicable. Higher TDS, as I've told you, that if PAN is not furnished or if it is non-filer, then higher TDS will be applicable. Here one has to be very careful, because what is happening, because of operation of Section 40A1A, the 30% of purchase consideration is getting disallowed. It may be allowable in the year when finally you make the either you get the certificate from deductee that the tax has been paid, or finally when you make the payment of TDS. But consider the situation when your turnover is, say, for example, 10 CR, and when your purchases are 8 CR on which you have not deducted the TDS. Maybe by not having Section 194 awareness or whatever it is, then assume that instead of having 2 crores profits, that is 10 minus 8, your 8 CR ka that purchase out of that 30% will be disallowed. In the sense, 5 lakh 40 will be 2 lakh 40,000, 2 crore 40 lakhs will be disallowed. So your profit will not be 2 crores as we have just calculated, but it will be 4 crore 40 lakhs. And in such cases, one has to be very careful for this application of Section 194Q. Now, there are always overlapping provisions. Section 194O is there. Section 194O, though I have not covered in detail, I'm just summarize you that it talks of TDS tax deducted by e-commerce operator from this amount credited to e-commerce participant in excess of ₹5 lakhs, and the limit is 1% as compared to 0.1% in case of 194Q. So it is almost 10 times of 194Q. So now and secondly, you are aware that 206C1H, which talks of tax collected on sale of goods, which is just a mirror image of 194Q. There also the rate is 0.1%. So now take a situation, 194O provides for 1% TDS, 194Q provides for 0.1%, and 206C1H provides for 0.1%. So there is again, this one transaction can invite at times, not always, but it can invite, implications of 194 also, 194Q also. And if you see the counterpart, that is from seller's perspective, it can invite 206C1H. So this circular provides from hierarchy. So when 194O and 194Q attracted, so the tax is deducted under Section 194O. So then 194, you have to go for 194O only because the tax is higher. That one has to understand. Now 194 and 206C1H is also attracted and tax is deducted under Section 194O. So that is okay. So 194O overrides 206C1H also and 194Q also. Now when tax is already collected under Section 206C1H, but 194O is also attracted. So 206C1H, if you have collected 0.1%, But still that 194O will be operational, and again additionally 1% you have to deduct. Similarly, provisions of 194Q and 206(1)H both are attracted simultaneously. That is just a mirror image. 194Q is from purchaser's perspective, 206(1)H is from seller's perspective. In that case, that TDS is required to be done from 194Q. And tax has already been collected under 206(1)H, and provisions of section 194Q and 206 both are attracted. Then one has already collected and the rate of TDS is same. So it's okay. You don't have to do anything about it. Now I have given you a comparative statement of 194Q and 206(1)H. So there here, section 194 talks of TDS, 206(1)H talks of tax collection at source. Now obligation is on buyer. Here the obligation is seller. Obligation is when the turnover is exceeding 10 crores in both the cases when preceding financial year, and transaction limit is 50 lakhs per purchases, 50 lakhs per purchasers or 50 lakhs per sellers in aggregate in a year. So any sum for purchases, the nature of payment is for purchase of goods, and here the consideration for sale of goods. Now here the timing is very crucial. As far as 194Q is concerned, it is credit or payment, whichever is early. So when you raise the invoice and when you credit to his account, at that time you have to deduct the TDS. Or if you make the advance payment to your supplier, in that case also you have to make the payment, whichever is early. Whereas TCS will wait, they will wait till the time you are receiving the money. So when you receive the money for sale of goods, at that time you have to collect additional 0.1% and make the payment of taxes. When 194Q is not applicable, if tax is deductible under any other provisions, we have just seen that 194O is applicable and they have deducted under 194O. In that case, it is not required to be deducted once again. Or if tax is collectible under any other provision except section 206(1)H. So 206C, any other series like sale of timber, sale of scrap, sale of coal, etc. If that is applicable and tax is already covered under that 206C series, in that case, you don't have to deduct once again. In this case, if tax is TCS on sale of goods, if tax is deductible by the buyer under any other provisions, in that case, you don't have to do it once again. Deducti collecti, any person who is a resident, a seller, that is, and secondly, non-resident if he is having a P. Whereas this, it is not applicable, 206(1)H is not applicable to government, local authority or importer. The next is TDS in case of business or profession perquisites and benefits, 194R. Now this is a new section which is going to be inserted with effect from 1/7/2022. And this being now the time is approaching very fast, so I thought we will discuss it. So here we will just understand the background. Just one. Just 1 minute. Screen sharing has stopped. Okay. $194. So this 194R is effective from 1st of July 2021. Yeah. Section 28(4), which talks of any payment of benefit or perquisites, if you have received in, then that is whether convertible into value of any benefit or perquisite, whether convertible into money or not. If you have received during your exercise of business or profession, in that case, it is section 28. Take an example. A car is given to a sports person, a cricketer, at the end of every IPL match. Now that car is given as a brand ambassador or as a sports person or for playing his cricket well, So this value of such car is taxable in the hands of as his professional income under section 28(4). Similarly, so many dealers and distributors are getting some advantage by way of gold coins or some outstation tours or tours abroad or some fancy gifts. But though it is taxable under section 28(4), because the same money has been paid in, because the this benefit has been received in kind, the value of this is not reflected in bank account, and definitely it goes out of the tax net, or at least that is the perspective of our finance minister. So just to take care of this, this TDS has been, provisions have been introduced under section 194R. So what does it say? It says that TDS at the rate of 10% is to be effective on payment of any benefit or perquisite to resident, whether it has been paid in partly in monetary or non-monetary consideration or only non-monetary consideration. In that case, TDS has to be effected at 10% limit. However, the basic threshold limit of rupees 20,000 is taken, where below that, you don't have to deduct TDS. Obligation is only on any person responsible for providing benefit or perquisites, including principal officer in case of a company. So in case of an individual or HUFs, one has to check the limit. So if your turnover if you're carrying on the business and if your turnover in the preceding financial year is 1 CR or 50 lakhs in case of a profession, then section 194R will not be applicable to you. So when payment is made in kind, it may not be possible for TDS, but to ensure that tax is deducted by pay. This is to ensure that tax has been deducted. Whereas all other section talks of deduct. So there is a difference. Why? Because normally this is going to be partly in kind and partly in cash, or maybe fully in kind. So how to take care of TDS? Now, if it is wholly in kind and if there is a credit balance of recipient, you debit the account or recover and ensure TDS is paid. So take an example where your brand ambassador is paid 50 lakhs rupees as a by way of fees, and over and above car of 20 lakhs rupees is also gifted. So 2 lakhs rupees TDS you have to effect under 194R. Take a confirmation from his account, from him, and deduct TDS from that fees which are required to be paid. Now there is a partly in cash and partly in kind, deduct from cash component. But if cash credit balance is not sufficient, ensure that TDS is paid either by taking a check from him, or if he is not agreeable, maybe you have to bear it, and maybe in such cases grossing may also be required. There is an old judgment of CIT versus Mahindra and Mahindra Limited, 255 Taxman 305, which takes that transactions which are fully in cash are not covered as section 20. It was in respect to section 28(4), equally applicable to section 194R. Naturally, they are not covered because they will be covered under any other section, say for example 194J or 195 or 194H, etc. Now, when you talk of perquisites and benefits, normally one talk of salary. Now, if it in respect of salary income, whatever we have learned, So there the valuation rules are given and the perquisites have been defined. Here there is nothing which perquisites and benefits are not defined. So there has to be first two things, benefits or perquisites provided to the recipient resident, and benefit is providing in relation to business or carried by that assessee or exercise of profession. So there has to be the existence of nexus between the business of recipient resident and benefit provided to assessee. Now, what is perquisites? So perquisites denotes meeting out of an obligation of one person by another person, either directly or indirectly, or provision of some facility or amenity by one person to another person from the very beginning. And the person providing such facilities knows that whatever is being done is irretrievable to him, as it has been granted to a person as a privilege to right of person. So just take something that, insurance company, they are taking all the agents who have exceeded their target to Singapore tour. Now, this is in connection with there is an existence of business of the insurance agent vis-a-vis insurance company, and they are getting a benefit which is attached to the exercise of their profession or business of collecting agency commission. So there is something with the commission is already given. Over and above this tour is also given. So now the value of that tour will also be subject to TDS. There has to be connection between, and it should fall within the perquisite or benefit. If the additional commission is given, definitely it will be subject to section 194H. But if it is given by way of a perquisites and benefits, then it will be covered under section 194R. So when a consideration is circumvented and paid in the form of benefit or perquisite, section 194R will be acted. But there has to be in addition to whatever is required to be paid, and should not be a proper condition of performance of that contract. In such cases, it cannot be considered as a perquisites and benefits, and it will be not liable to be taxed under section 28(4). So take a case of David Dhawan, where Mumbai tribunal held that it is this director went to Switzerland, whose tour cost was paid by the producer, and even his family members of this tour cost were also paid by him. So the tribunal held that unless and until he is comfortable in his family atmosphere, he will not get his creative ideas, In such cases, there is no additional benefit, but it is given for the proper performance of his work as a director. And that's why it is not considered as a perquisites and benefits liable under section 28(4). So such transactions, if it is just a part of the contract, then it cannot be liable for section 194R. The area is very gray and will be eligible for, attract lot many litigations in future. Now here, no valuation rules are prescribed. Power is given to CBDT to issue guidelines to clear, many doubts, but it is binding on income tax authorities and person providing such benefit or perquisites. So just to conclude 194R, but it is not made applicable to recipient who can take his own opinion. As we are aware that no valuation has been prescribed under section 28(4) or in the section, then what should be the cost? Now, value, perquisite or benefits are to be considered. Now, how do you define the value? There are no valuation rules as given in salary section, rule 3, etc. Here, though, there are no valuation rules. So, what is to be taken? When a motor car is given to brand ambassador to Dhoni for his performance by Tata Motors, what should be the consider? Whether cost in the hands of the company whether cost in the hands of a dealer, or whether selling cost, or whether cost which has been considered for GST purpose. So what should be considered? So valuation rules are very tricky, and what should be, what is to, whether fair market value is to be considered, whether Rule 11 UA is to be considered, whether only cost is to be considered. So all those issues are remain, and it will be answered maybe over by issue of circular, or maybe one has to wait. But the time is nearing, and this issue has become very critical. The last is TDS in case of a virtual digital asset. You are aware that transfer of this virtual digital asset, that is crypto or NFT or other virtual digital assets, have been made taxable with effect from AY 22-23. And now because of that, this TDS provisions under section 194(s) is also made applicable. TDS is to be deducted at the rate of 1% of consideration for transfer of this virtual digital asset, and transferor is a resident, then this is applicable. Now 1% consideration one has to deduct, but it is not applicable to specified. It is there are different threshold limit for specified person and for others. So if a person is an individual in HUF, if he is not having business income, or if he is having business income but turnover in preceding financial year is less than 1 CR or 50 lakhs in case of a professional, then the limit is 50,000 rupees for aggregate of transactions and not one transaction. Whereas for all other cases, that is a case of company, firm, LLP, AOP, etc., the threshold is 10,000 only. Again here, when there is no TAN, for specified this person not having business income, individual HUF, or having a lesser turnover, there is no need for having TAN. So one has to effect TDS through one challan, like how we are doing in case of a sale of a immobile property. In case of a non-pen, again higher rate will be applicable. Now there can be TDS under more than one provisions, as I have told you that in this e-commerce also will 194(o) also may be applicable to the same transaction, and 194(s) will also be applicable. So here in earlier cases we have seen that 194(o) takes precedence over 194(q) and 206(c)(1)(h). Here 194(s) will take precedence under 194(o). Now this is, there are so much of uncertainty how this will work. This valuation, there can be, how to do it, when there is a over-the-counter sale, where you are selling some crypto to, 1A is selling to B, then one can effect and the value of is going more than 10,000 or 50,000 rupees. Then one can effect TDS under section 194(s). But generally we have seen that all these transactions are happening through crypto exchange. So maybe Wazir or Kuber or whatever is the, but these exchanges are not regulated, neither they are recognized. And so in such cases, how this TDS will be effected? So you will be, say for example, that you are purchasing this Bitcoin from a crypto exchange, but who is the seller you don't know. So how you are going to, because there is no privity of contract between you and the seller. So how this TDS will be executed? So whether the exchange will take care of it, because when you are, say for example, when you are selling it, so the exchange is purchasing in turn and assuming that it is also selling to another party. Maybe in such cases, whether exchange is required to do it, whether the exchange is equipped to handle such kind of TDS, one doesn't know. And this is also again made applicable from 1st of July. So the time is very short. Maybe one is expecting some clarification on this. Secondly, so now here also the CBT has been given power to board to remove difficulty. Let's expect that some before 1st of July, we will get some more clarifications how to handle this. So now what will happen that again, that one is selling, one is purchasing this virtual digital asset in exchange of selling something. So how do you handle it? Again, the valuation rules will be difficult. One has to consider these valuations of this. And so this crypto is going to create lot many issues. Again, if we are not able to recover from the seller, then in that case, are you supposed to gross it up and make the payment of that? Or you may make the payment and seek reimbursement. So these issues are going to be there. Again, what will happen when you are making the payment, when you are buying, when someone is paying you this this coin, bitcoins, assuming, in performance of your services. So how do you take care of TDS? How do you value it? So those issues are going to remain. The issues of valuation, the issue of who will handle this TDS part, the issue of how do you recover this TDS, because finally TDS is no burden on your pocket. It is just to be recovered, or out of your total amount, you have to take out some money and you have to make the payment. So how do you recover? Even that is a question. In case of a exchange where you don't have privity of contract, how do you handle it? Whether crypto exchanges have been given notice to handle this, because they are not regulated by SEBI or by any other agency, and there is no exemption which have been given. As far as TDS, as far as gift cases of VGA, this virtual digital asset is concerned, there cannot be any TDS because it is in case of only give. Only in case of a purchase, this TDS is applicable. Now, one last thing, though it is not applicable for current year, it is not come into it is there since time immemorial, but this is a difficulty which I have found in many of my clients' case, and I am sure you all also must have found it. So dividend was always tax-free, since last 5-10 years, in our hands, because DDT was paid by the company. So with effect from 1/4/20, the dividend is taxable in hands of shareholders. And TDS is deducted under section 194 if it is more than 5,000 in case of a resident individual shareholder. But there is no threshold in case of other assets. Now what happens, there is a demat account in case of take a case of a partnership firm. The demat, depositories, they are not opening account in name of a partnership firm, but demat account is always opened in name of a partner. So credit of TDS will appear under PAN of a partner because demat account is attached to PAN of a partner and not a partnership firm as such. Or in case of a member, in case of AOP, name of a member. So credit of TDS will go to section in 26 AS of a partner, whereas the income belongs to the firm, so the credit of TDS should also go to partnership firm because the income is being offered by the firm. So here, Rule 37BA, which is already there in the books, will come in play. I am drawing the attention because I have seen in many of my clients' case and other clients also, other assesses also, that Rule 37BA requires you to submit a declaration to the deductor that this income is not belonging to you, but it is belonging to another assessee whose name and PAN and reason for such credit it should be transferred to the entity is given. Now, on strength of that Rule 37BA, there is no specific format, but each company has a separate format. So, on strength of such Rule 37BA declaration, the credit will be transferred to PAN. I have seen in many cases that this has not done in many of the assessees case, and the credit of TDS is getting jumbled in name of a partner where he is having just a single demat account, of where he is having shares of partnership firm also, where his own shares are also there. Or when even if he is having a demat separate account, all the credits is appearing in 26 A's and AIs of a partner. In such cases, it was advisable that they should have furnished 37BA declaration in where each company is sending along with dividend intimation, but it has not been done, and we are trying to get the credit by incorporating such details in TDS schedule of ITR. One, whether gets the due credit or not, the time will tell, because still the intimation has not come. But I'm just drawing the attention to advise the clients that to furnish the declaration in case where the shares of a partnership firm is held by a demat account which is under PAN of partner. These are the issues, and I am really thankful for the time given and the opportunity given to share the knowledge, or rather first to study the topics which are of recent importance. Thank you very much.
Thank you, Ninaben. Thank you so much. It was an excellent session. We have few questions by the participants, but considering the time limit, we will take only 2. And I think quite a few of them have already been taken up by Nina ma'am in her presentation. So there is one repetitive question: why we are not able to download Form 16A even after filing TDS return? Ma'am, if you can.
It is, you are not able to download after this submitting this Form 20, this quarterly statements?
It seems like that only from their question. They have filed the return, but then it may be some technical issue.
It may be technical glitch. Contact Traces. They are helping you. Contact Traces.
Okay. Ma'am, the next question: if the deductee has filed updated return now for earlier 2 years, whether in financial year 22-23 still he will be specified person?
For 206 AB you are talking about? No, if he has filed updated return, then I think the reference is seems to be whether he is non-filer and the higher rate of TDS is applicable. Yeah, in that context. So if he has filed updated return, he has filed return of income. In that case, the higher rate of TDS under section 206 AB will not be applicable to him.
Okay, ma'am. Thank you so much. Good evening all. This is CA Pallavi Mayur from Jalgaon. And thank you, Nina Ben, for such a wonderful session.
Thank you.
I remember you. You have once come to Jalgaon, and we were very happy to hear you then also.
Yeah, so many years. Yeah. With Jalgaon, I have a long association, Right. I keep on meeting Niranjan Bhai and Anil Bhai.
Yes, ma'am. We will like to see you again there in Jalgaon. Okay. So, thank you, ma'am, for sparing your valuable time and explaining us in detail the intricacies of the existing provisions of TDS and TCS along with the new additional provisions introduced and will be now applicable. Actually, this subject is very important because a small mistake will lead you to penalty provisions. Thank you again. I also thank WMEC Women's Empowerment Committee for giving me the opportunity to be there in today's seminar. Thank you, Chairperson CA Shripriya Kumar Ma'am, Vice Chairperson CA Preeti Savla Ma'am. And I also thank CA Gyan Chandra Mishra Sir for his special address, CA Palak Tikmani for coordinating, and all the participants of today's seminar. Thank you. Seeing the time constraint, I think we should start with the next session. Thank you. Shefali Arora, ma'am.
Yes, good evening to everybody. Pallavi, do I just start?
Just a minute. Jinal, where is Jinal Savla, please? Jinal Savla.
Yeah,
please unmute.
Hello. Good evening, everyone. I will introduce Shefali Arora for today's seminar, who is going to speak on financial advisory. Shefali is a chartered accountant and a partner at ATMS and Company LLP. She has been a member of ICAI since 2002. She has also successfully completed certificate course on wealth management and financial planning from ICAI. She handles the people management of the firm and has seen it grown from a 5-member team to a team of 122. Through her journey as a CA, she has developed a passion to spread financial knowledge to her clients, especially women, and help them to attain their financial goals. Currently, she has helped more than 150 families in creating wealth. Her husband, CA Samir Arora, is also a renowned chartered accountant with vast experience of 23 years. They have 2 sons. Along with her career, Shefali also finds her happiness as a philanthropist. She has also been instrumental in starting the Mulund Center of Angel Express NGO. She also conducts various team building programs to instill bonding in her firm. Her favorite event is Good Deed Week, where everybody in the firm participates in giving back to the society. She has coordinated numerous events of ICAI in the past. So this is a brief introduction of our today's learned speaker, Shefali Arora. Over to you, Shefali. Thank you.
Thank you so much, Jinal, for the warm welcome, and a very good evening to all my CA fellow friends. I would like to start with firstly thanking WMEC and Preeti Savla ji for giving me this opportunity to share my thoughts on this forum. Friends, you must have all heard about the famous celebrity Govinda, isn't it? So he was at the peak of his career in 1990s, and a few years, very talented, very good performer, very good dancer. Later, we hear a news that he has gone bankrupt. Okay, so was it because of his lack of talent? No, it was because of lack of financial planning. So, friends, if you see a Govinda in your clients, or if you see a this Govinda in yourself, it is high time that you have a financial plan for yourself. Let's go further. Can you see the shared slide? Can you see the presentation?
Yes, ma'am.
Okay. So first, the most important question, why financial planning? Because failing to plan is planning to fail. So friends, if you have seen the current generation, they like to live their life king size. They want immediate gratification of their needs. Bas abhi chahiye. Like Leila in Zindagi Na Milegi Dobara said, seize the day my friend, पहले इस दिन को पूरी तरह से जियो, फिर 40 साल के बारे में सोचेंगे. So if we talk about the expenses, the old day expenses were what? Roti, kapda, makan. And the new age expenses have changed completely from Gucci to Nike to maybe watching a movie in the malls, to shopping, and the list is endless. There are so many avenues. The generation today, they are influenced by Instagram. बस जो देखा वो किया, and they are completely of a different thought. In fact, the career to change. Around 10-15 years ago, we had not even heard about a social media influencer or a career like a app designer or a blogger, etc. So my friends, this also means that your job is not safe. Your income is not safe. Every 12 to 15 years, the existing jobs have become outdated, and completely new skill sets are required. If I have to summarize, we can say that we cannot, in today's world, be solely dependent on our active income. Active income, matlab, our 9 to 5 job, waking up, going to office, working for a whole month, and in the end of the month, you are rewarded for your efforts in office, and that is your active income. So this means you have actively worked to get that income. So iska matlab kya hua? Does this mean that your dream of having a house in Goa cannot be fulfilled? No, my friends, there is a hero for our savior, as a savior, and that is financial freedom. Very important. What does financial freedom mean? Financial freedom is having enough to lead a very comfortable life. That could be your savings, that could be your financial investments, that could be your cash on hand, to afford the kind of life we desire for ourselves and our family. Financial freedom also means that you do not have to work for your money, but your money works for you. And it also gives you the freedom to choose. So I'm sure many of you have read this book, Rich Dad, Poor Dad, by Robert Kiyosaki, in which he highlights a beautiful concept: passive income. Passive income kya hai? Completely opposite. Active income means you have to work for the money. Passive income means money working for itself. It is the income that you receive from your assets and your investments. Passive income means money growing even when you are asleep. It means money earning more money and absolutely no efforts, no active involvement. So passive income is equal to financial freedom? Yes. Firstly, because all your monthly expenses, your bills, your taxes, everything should be taken care of by your passive income. You do not have to work to sustain your living. It completely brings you out of the rat race, and it gives you the liberty to follow your passion. Remember your younger days dream of maybe starting your own business, having a cafe, living a very, very comfortable life. That can be achieved with financial freedom. That can be achieved if your passive income is enough to take care of your normal expenses. And you can become financially independent. How? In just 5 easy steps. Let's see them in detail. So this is the basic process: goal setting, risk profiling, planning, implementation, monitoring and reviewing, and celebration. That's it. Now let's see each of them in detail. So the first step, set your goals. Okay. This means that you could buy your own car. Your goal could be to your child education. It could be your child marriage. Your goal could be buying a house, traveling around the world. Who does not want to travel? Who does not want to see places around the world? Your goal could be that. Your goal could be starting up a new business. And the most important goal, retirement. We want an absolutely comfortable retirement, don't we? So the first step is jotting down all your goals. And once you have done that, put an amount to your goal. What is that amount which will help you accomplish that goal? So one after the other, for every goal, you put in an amount, including inflation. And then what? How do we achieve that amount? Very simple. Your savings plus compounding is equal to the corpus for that goal. So we apply this formula for each of our goals. Your savings means the amount that we save. That means the amount that we have in our hand, surplus amount that we can invest. Compounding, I am sure I do not need to explain the importance of compounding. As per Albert Einstein, compounding is the eighth wonder of the world. It can create that magic in our lives so that we can accomplish our goal, fulfill our goal. Achha, when we talk about savings, my friends, there are two very important things. First is your behavior with regards to savings. When we think of savings, the first thing that comes in our mind is jo bach jayega at the end of, but that is completely wrong. That is the aam janta formula. Okay. Income minus expenses is equal to savings. But we intend to become financially independent janta. That means we are financially independent, and for that we need to bring in this behavioral change wherein your income minus savings is the amount that I have for my expenses. And how do you get these savings? This amount, your goals determine this amount. The second most important thing is discipline and bringing your investments on autopilot. Like we have a discipline, exercising discipline, your Apple Watch giving you reminders every day to exercise. Similarly, there is a discipline we need to follow for our investments as well, and put it on autopilot. You cannot, because the truth is that you cannot think to save every day. Every day I cannot think and sit and think, okay, today how much I can save. It is not possible. There is your mind which creates resistances. There is a mind which will every time tell you, no, let's go and buy that jewelry. Let's go for the Goa trip organized by your friends. We have to put our investments on autopilot, and the best way to do is by way of SIP. Perfect discipline and autopilot. Step 2. We are done with the goal setting, goal planning, but it is said that every goal without a plan is only a wish. So now the corpus. How do we do that? We shall come to the second part, that is risk profiling and asset allocation. So, friends, there are three types of investors, broadly categorized. Okay, first is aggressive investor, second is a moderate investor, and third is a conservative investor. As the name suggests, aggressive investor is high on equity. He is absolutely ready to take that risk for higher return. So in his portfolio, equity portion is always going to be on the higher side, say 70 to 80%, and debt will be on the lower side. The next kind of an investor would be a moderate investor, also known as balanced investors. They like to balance their portfolio in a way that it is 50-50, 50 equity, 50 debt, or 60% equity or 40% debt, and they would like to grow their investment. Third is the conservative investor. The person who does not want to take any risk. Capital protection is really important for them, even though low returns. It gives low returns. So they invest more in debt securities and less in equity. So once the risk profiling is done, then we come to the asset allocation. Asset allocation means dividing your investments among different assets such as stocks, bonds, REITs, gold, crypto, etc. So your asset allocation can be of two types. First is it is based on age. Very simple. The most basic one. If you are 25 years old, 70% equity and 30% debt. If you are 60 years old, reduces to 30% and debt increases to 70-80%. So you are heavier on the debt product, safe kind of investments. The second is based on your status. So even if you are 60 years with a net worth of 25 crores, that means your passive income, your interest on these 25 crores can easily meet your monthly expenditure. Hence, you can take that extra exposure in equity. So easily you can invest 70% equity in equity and 30% in debt and fixed income product. But on the other hand, if you are 60 years with a net worth of 2 crores, then you definitely have to keep a very less exposure to equity. You have to give a very less exposure to equity. So there is a thumb rule of finance. Never put all your eggs in the same basket. Remember our grandparents and remember our parents. Their favorite was fixed deposits. All their investment, all their savings were used to be in fixed deposits. Low return and very risk-free, but very low return. And what happens if the bank just shuts down? We have had two examples in our neighborhood, Punjab, Maharashtra, and there was the bank, the CKP bank. What happened to the money of the account holders? People are still struggling to get their lifelong savings back. So hence, it has to be a mix of equity, it has to be a mix of real estate, debt, equity, mutual funds, etc. Step 3, investing. Now, once the risk profiling and asset allocation place, the next step comes to investing. Where do you invest? Let's see this in detail. So there are various kind of assets. We all know this. Equity, fixed income product, there is gold, there is real estate, crypto, and the list is endless. We have to find the right mix for us. Talking about equity, it is one of the favorites. Okay, stock market, people have been talking about stock market. Very high returns. बोलते हैं ना, risk है तो इश्क है. This is a perfect description for equity. If you are ready to take risks, please invest in equity because equity has the capacity to give you good returns if invested for a longer duration. If we talk about equity products, there is direct equity. That means directly investing through stock markets. Then we have the PMS, Portfolio Management Services, and the AIF, Alternative Investment Funds, with a ticket size of 50 lakhs and a crore of rupees respectively. Mutual funds. These are also a form of equity products, and the risk between these products depend upon the concentration of the money in the stocks. So if we talk about mutual funds, the number of stocks increases, hence the risk gets diluted. So if we see this graph, friends, sorry. So if we take any 10 years period in equity, equity has given a positive return, much better return, much higher than inflation. And say in 2002, if the Sensex was around 15,000, 2021-22 has seen Sensex go about 60,000. So it definitely a part of your portfolio has to be invested in equity. Fixed income products. हमारे grandparents का favorite, low risk, low to medium returns. If we see the products, there are fixed deposits, bank fixed deposits. PPF gives us, PPF is a very good investment as investment vehicle for long-term goals, for our goals like our children's marriage or retirement. Currently, the PPF rate is 7.1%. We have our post office schemes, extremely safe. Corporate bonds giving a little higher rate of return, but taxable, of course. We have the RBI floating rate bonds. This, of course, is becoming really popular. It is currently giving 7.15% rate of return, but it has a lock-in of 7 years and it is taxable. Gold. Every household in India has gold. Gold can not lose its value, and it is a good hedge against inflation. What does that mean? That means that over a long term, gold has been able to deliver higher than inflation return. So if we talk about our portfolio, gold can easily be around 5 to 10% of investment. Real estate. Again, very popular. Everybody wants to own a house. एक घर हो, अपना घर हो. But it is very capital intensive. It requires a big chunk of money for investment. Low on, highly illiquid. Maybe when you require that money, you might not be able to liquidate that asset. And it also has a high entry and exit cost. REITs, a new way of real estate. It is a very new product. Currently, there are three trusts which own REITs and through which we can invest. Embassy, Brookfield, and Mindspace. It is kind of a mutual fund for real estate. It is a debt product and highly regulated. This means that This means that 90% of the income has to be distributed by the company, by the trust to its shareholders. So one can easily expect a return of 8 to 10%. Moving further, cryptocurrency. Again, a very new form of investment, very popular among the Gen Z especially, very volatile and very high risk. So we should invest only if we understand. My exposure to crypto is as good as nil because I really don't understand the complexities of this currency. If you understand the blockchain, if you understand that it is a decentralized finance, no regulations at all, please go ahead. You can keep 5% of your portfolio in cryptocurrencies. Major types of cryptocurrencies: Bitcoin, NFT, Ethereum, and the list is long. Step 4. Chalo, all our investments are done. I think somebody is on unmute. If I would request that person to mute yourself. Thank you. Step 4 is reviewing and monitoring. See, our goals are done. Our goal planning is done. Our risk profiling, asset allocation is in place. We have invested in proper baskets. What we mean by reviewing and monitoring is that it is utmost important to check course. We have to see whether our plan, whether our investments are moving as per our plan, and if not, immediately rebalance as per asset allocation. Step 5, celebration time. So you have now accumulated your corpus. Go and buy that house for which you have been investing. Go and buy that car you have been eyeing for long. Give your child your best education. Go for the world tour. In simple words, just celebrate the fruits of your discipline and commitment. Celebrating is very important, and for my clients, I see to it that they do not miss out on any of the celebration. So if coming back to my earlier example of the celebrity, we might not find a KBC to recover our debts. Amitabh Bachchan ji was very lucky. But we might not find our KBC to recover our debts, but we can always have a good financial plan in place to help us in our rainy days. Thank you so much. If you all have any questions, I am here to answer them, or you could just write to me and I will be obliged to answer them. Bye. Thank you so much.
Thank you, Shefali. It was really nice, your nice presentation.
Thank you, Prithvi. Thank you so much for giving me this opportunity of sharing my thoughts here.
Always welcome. So any questions are there? So we can take up those questions. Pallavi, Madam, Palak, Ruchi, Shanu, questions are there? So we can in next 5 to 10 minutes take up the questions for Shefali.
Yeah, ma'am, there is one question. Investment in crypto level, how risky is it?
As I earlier said, crypto has its own complexities. It carries a very high risk. Your investment. See in the last slide, if you see, there was Elon Musk. He tweets and the crypto value appreciates or depreciates. It is that volatile. It is not at all regulated. So only if you understand, you should invest. Hence, I said that you can keep 5% of your portfolio in crypto, but not more than that.
Ma'am, but even the equity markets nowadays are very, very volatile. I mean, every second, third day, there are.
Equity markets are always volatile. I think from beginning, it's better and safe to invest in mutual funds in that case.
Correct. But if you compare equity markets and cryptocurrencies, my vote goes to equity markets because volatility, if there is no volatility, how will you earn? I take it as an opportunity to invest more. Prices will come down, you invest, and when the market goes up, when the markets go up, you can always sell. So hence that volatility is required for investment in equity market. And yes, as Preeti ma'am said, the mutual funds work very well in equity markets, especially the SIP way. If you get the SIP way, when markets are down, you earn that much more units. And in the end, you have earned that much, but you have collected that many units to give you a good return in the end.
At least 3 to 5 years should be your investment period in equity.
Definitely, more than 5 years.
Okay, Shefali ma'am, it was a wonderful session.
There are questions in chat box also. There are few questions like how to invest in government bonds and corporate bonds from Rasika Chakta.
Okay.
So government bonds, of course, there are many forums that like say NJ Prudent, through which you can invest into government bonds. RBI Direct gives us a direct platform. It is a direct platform where you can invest in government bonds and other corporate bonds. Then there is AK Securities, which can help us invest in the same. It's very easy. It's very easy. We have
So you
many
can
online
direct also, and you can take the agency also. If you want to invest for your clients, suggest some to your clients. So you can take the agency all, matlab, not in your name, but
not in our name.
if you are in the practice having a COP. How good is sovereign gold bonds?
Gold bonds, this is again a very new form of gold investment. You should invest through gold bonds, sovereign gold bonds. One, because there is no jhanjat of holding that physical form of gold, keeping that in locker and keeping them safely. So the sovereign gold bonds directly come into your demat. There is a 2.5% interest that comes in, the government pays. And at the end, there is again a lock-in of 7 to 8 years. So at the end of the 8th year, during maturity, whatever prevailing rate will be there, the amount will automatically come into your bank account. So sovereign gold bonds are a very good and easy way of investing in gold.
In the gold in paper form, I can say. In
Yes.
demat form, paper,
Yes.
gold in demat form. And the rate
Physical
what you get at the time, if you sell, at that time, the market rate you get on that.
Yes.
How much should be your corpus at the end of the retirement? The question is from Ashwini Doshi, Solapur.
Yes. So according to me, at the end of your retirement, the corpus should be easily around 5 to 6 crores of rupees, because if you calculate if you just take 6% annuity on the corpus, that becomes 36 lakhs per annum. Divided by 12 is 3 lakhs per month. If we consider inflation, and if we consider that you are getting retired after say 12 or 15 years, 3 lakhs would be easily the amount that you would require to meet your monthly expenses. So for that, for earning that 6 lakhs, you easily require a corpus of 6 crores. 5 to 6 crores is something that I generally suggest to my clients.
Again, it depends on the area where do you stay. So because the standard of living, the cost of expenses is different in the different areas. So if you are in say Mumbai or metro cities somewhere, then it may be different. If you are in 2-tier, 3-tier cities, it can be something less, because the cost of the stay, cost of living is different in the different areas.
Very true, very true.
Yeah.
Yes, so this was Bombay, that was I was referring.
Yeah.
There's one question: selling stock come dividend is better or ex dividend?
Sorry, ma'am, I didn't get the question.
When you sell the stock, so you should sell it with dividend, or it is better to sell it ex dividend?
Preeti ma'am, if you could like to throw some light on
So
this.
I did not understand the question actually, but it is mainly for the tax purpose or what, I did not get, matlab ex dividend or what. So when if any dividend is received, so tax is already deducted as per the income tax laws. So it is DDT which is deducted, the company deducts, and then only the dividend comes. So accordingly, you can take it further, but I did not get the question exactly.
It could be with respect to rates, like when it is with dividend, whether we get good rate in the market for that.
Another question is, should we think of buying house in metro cities, considering they are overpriced and considering current real estate market is somewhat sluggish? In my view, if you want, what do you exactly want? So if you want to buy in metro cities, there are various things you have to consider. See, house is like it's a one time, only in lifetime, only once you purchase, and that is your biggest investment of life, to have a house. So I would suggest that what you want your life to be, what you want your surrounding to be. what you want your gentry to be, where you want to stay, what you want your neighbors to be, and accordingly you have to choose your lifelong area in which you want to stay. It doesn't matter about the price. If you desire and if you feel I want to purchase in this area only, and if you want your surrounding like that, you should always go for the house in metro cities. Because you again, if you feel I want to stay in suburbs or some other areas, you are happy, you want that type of people around you, you want that type of sometimes the house is also purchased taking into consideration the education. So what good education for the children are there, and what you are thinking it is good over there. So that are multiple factors which are to be considered, and it is very personal basis to purchase the house. There is another question for you, Shefali. Can you suggest some mutual fund for SIP?
Yes. So Roshni, the most easiest and the simplest form of mutual fund is the index fund, which tracks the Sensex. Okay. So to start with, if you are a first time investor, please start with index funds. But as and when we can always look at large cap again. Here your risk profiling is very important. If you're ready to take some risk and you are investing for a long term, you can always go for put a little portion in mid cap funds, a little portion in the small cap funds. And if you want to take lower risk, please go for a good large cap fund. Maybe SBI large cap or Mirai large cap is a good fund. But if you are just starting an SIP, I would suggest that you go in for index funds.
In my view, if you are asking for the mutual fund, which mutual fund, in that I would suggest don't go with only single mutual fund. Try and invest in two different funds, or some amount in one mutual fund, some amount in another mutual fund. If you feel you want more returns, if you have a risk taking abilities, in mutual funds also there are different types of funds. So small cap, mid cap, large cap, debt funds, arbitrage funds, like that. I know all these things because I am on the board of one mutual fund. So that's why I know a lot of things about mutual funds. So in that case, if you have a risk taking capabilities, then you can go for small cap fund or mid cap fund, which may give you more returns or sometimes may not give also. Large cap, as Shefali has said, are like the mutual fund also invest into the share market. So large cap, you divide your investments into different mutual funds, and again in different mutual funds in different categories of the funds also. So everything is divided, and everything will not go in dabba at the same time.
Can I ask one question? Can we get more returns in mutual fund as compared if we invest in the large cap mutual fund? Can we get more return as compared to fixed deposit or post office investment? Because I never started SIPs and all mutual fund. I'm keeping post office and FDs and everything. Guaranteed return.
All depends on the duration of investment. With that, I mean, when is it that you require that money? Okay, if it is say if your answer is less than 3 years, then definitely you should not invest in mutual funds. Debt mutual funds, yes, but equity mutual funds is a complete no. But yes, if you have a longer horizon,
longer horizon means for more than 5 years or up to 10 years. I want to invest for 10 years. After 10 years, I want the money. So for 10 years,
so
is
if
it
you
better?
Have a period of 10 years, definitely you should go in for mutual funds, and they will definitely give you more than your fixed deposit or your recurring deposits, post office schemes. Because they also have a tax.
You should divide. You should divide
4,
your
5 mutual
investments.
funds.
Something in the fixed deposit, something in the mutual funds, and in mutual fund also 2 different mutual funds, and in that also different schemes are there.
Correct.
So I think we have completed all the questions and live questions also by Roshni. So I think this was very live chat and interactive session so far, and lot of members wanted to understand about the investments and what I had thought we should have such kind of program. So thanks to Shefali for sharing her knowledge on this. And I request now coordinators to please take it further and give a very worthy vote of thanks. Pallavi, madam.
Yes. Thank you so much, ma'am.
Shefali ma'am, it was a session on the topic which is the need of an hour. The slide which you had showed that every 12 to 15 years, the existing jobs become outdated and new skills are required to be developed. It is the truth, and we should accept this truth, and we should work on that way. But many a times we want to stick to our things which we have been doing for years together. So this slide particularly I really liked. It was a very wonderful session and very effectively and simply explained. Indeed, all of us are looking for financial freedom and passive income. So I think today you have inculcated a thought process in the minds of the participants. Thank you so much, CA Shefali Arora ma'am, for your valuable time for Sky High Symposium 6. Once again, I thank WMAC of ICAI Chairperson CA Shripriya Kumar ma'am and my own Vice Chairperson CA Preeti Savla ma'am for giving me the opportunity. And I also thank CA Jinal Savla for coordinating the session, all the participants, and I also would like to say about Ruchi Gupta, who has very finely, she has taken care of the backhand. Thank you so much. And I think we have completed the session today, second session, and also the session for the day. Thank you so much.
Thank you, Pallavi. Thank you, Palak and Shefali.